everyone, a very good evening. You're tuned into The Money Show. This is the only daily show of its kind where we get you the top financial experts to help you out with all your financial queries. I'm Avan Devash and with me is Avni Raja. And Avni, let's get straight to it with the top headlines.
Absolutely, Avan. Lots lined up, but on the headlines first, a Supreme Court Constitution bench set to hear next week all the pleas seeking stay on Aadhaar linkage. Meanwhile, centred as the apex court, it may extend the deadline for mandatory linking till March 31st.
Meantime, the Bitcoin mania continues. It's at a fever pitch. The cryptocurrency has smashed around $15,000 and that's its latest record run, clocking in a stunning $3,000 up move within just a few hours.
And a sigh of relief on the Lal Street. Nifty claws back after a two-day sell-off to reclaim the psychological 10,100 mark. Broader markets outperform. All sectors participate with infra and autos leading the way.
Okay, today on the show we have with us Harshvardhan Roongta. He is a CFP at Roongta Securities. He will be helping us out with all of the viewer queries, and we've got lots to chat about as well, talking about NPS, whether it's a lot of pain and one should invest or not, as well as we said, we'll be taking on board all of your queries. But before we move ahead, let's hear it out from a big voice. We connected with the senior partner GMO, Arjun Divecha, to talk about the outlook for the Indian economy as well as some of the crucial developments overseas and the Fed. Let's listen in.
Well, 3.3 is a high number. I don't think that US can sustain that kind of number for a long period of time. Because if you think about it, what is economic growth? Economic growth, if you think of GDP growth, is a combination of two things. It is the participation in the workforce, so to speak, that is labor force, plus productivity growth. The sum of those two is GDP growth. So in the US, essentially we have reached a point where additions to the labor force are pretty close to zero. So therefore you're not getting the population growth. So therefore, to say that productivity growth can grow at 3.5% a year for a long period of time, that's really not possible. Basically, if you look at the long-term history, about 2% is what is really feasible. So we think in the long run, about 2% is perhaps the kind of the speed limit, so to speak, for the US economy.
But that's some part of the previous growth cycle, Mr. Divecha, because I remember the average for the cycle, in the economic cycle, that is, between 2002 to 2004, 5 was, at one point in time it peaked at 4%, but 3.5% was the run rate at that point. So
but remember, the demographics have shifted. Okay. That is basically what you've had in the last 10 years is a peak in the demographic cycle, where the number of additions to the labor force have now essentially
the participation rate has fallen.
That's
most
correct.
Definitely. I also, so what does the market, the bull market in the US reflect? What does this market rally reflect? Because every single day we wake up in the morning and we're like, okay, what are the cues from the US? Record highs. Right. Right. It's just not stopping. And that just reminds me of the newsletter that GMO put out at the end of Q2, authored by Ben Inker as well as Jeremy Grantham, saying, trying to answer two questions. One is why are stock market valuations so high? And secondly, why do fund managers continue to buy such high valuations?
True.
Explain.
Well, I think there's two contradictory things over here. One is that clearly market valuations are high. There's no question about that. Yeah. But one of the things that we've done a lot of work on is trying to explain what explains valuations in markets. And it turns out that it's a lot of what we call comfort or psychological factors that tend to drive the level of valuations. So when inflation is low, when corporate profits are high, when volatility of growth is low, markets tend to like that. And so
All right, that was Arjun Divecha, senior partner at GMO, in an exclusive chat with Tanveer Gill. But let's get to Harshvardhan Roongta now. Harsh, I want to, before we get to, the questions and other queries that have come in, I wanted to first talk to you about the National Pension Scheme, because it's an extremely important product from a retirement perspective, but there are a lot of positives and negatives that it has with the tax treatment. Only if you buy annuities will it be tax free on maturity. So all the positives and negatives, how would you advise for one to actually, whether one should opt for it or not? How should one look at it?
And do you think that the negatives outweigh the positives or not?
Yeah, so if you kind of look at the structure of NPS, I mean, this is a proper structured pension product. Now, what does an NPS do if you look at it in an absolute sense? So there is one period wherein an individual contributes into the plan, which is going up to his retirement. or at retirement, you're given a choice to withdraw a certain portion out of the corpus that has been accumulated over the period of time. So you're allowed to withdraw say 60% of whatever has been accumulated at age 60. The balance 40% has to compulsorily get converted into an immediate annuity offered by a registered life insurance company. Now if you, and thereafter you will start getting a particular annuity as per the option that you've chosen. Now you could actually structure this entire product by yourselves. Now for instance, if you were to invest into any product for that matter, it could be a mutual fund, could be PPF, could be any other product that you invest up till your retirement, the corpus that is accumulated, there is no restriction in this particular case wherein you have access to the entire corpus for yourself. So in case you wish to buy an immediate annuity as you are compelled to buy under an NPS, you could do that. If you wish to just put that money in a fixed deposit and earn interest on that, that is also possible. If you wish to put in a tax-free bond, you need to buy a property, earn some rent on that, that could become annuity for you. So how does an NPS separate itself out where there are certain restrictions? So in this case, all those people who cannot manage their investments on their own, all those people who look for a structured product for assistance will look at NPS. Why? Because it has an inbuilt discipline to it. You cannot withdraw in between before retirement. There's a structured as I said, a methodology wherein the money has to get converted into an immediate annuity plan offered by a life insurance company. Thereafter you will get pension regularly. So both the methodologies can be adopted depending on how an individual is structured towards it. The idea is, if you can manage your money on your own, it is far more flexible to do it by investing in mutual funds, for instance. One of the restrictions that the NPS has, despite it being a very long-term product, we advocate equities over a period of more than 10 years is the best asset class to be in. Now NPS, despite being a long-term product, you will have a fund option which invests only a maximum of 50% into equities. So it contradicts the entire thought of wealth creation over a long period of time. Now there is of course, as I said, a restriction on withdrawal, which is good and bad as well. I mean, depends on which side you are on. But considering all these factors, there is some limitations onto the acceptance of NPS as a product. However, all those people who wish to make sure that they do not want to manage the funds, they want it to be in a product which is automated and structured in a manner that pension is secured, well, you can go ahead with NPS. And all those people who are fine with managing their own money, I believe there are more flexible options available.
Okay, that's the complete lowdown, and very interesting. We've been flashing some pointers as well on your screens talking about what the general pain points are, as Avni was also flagging off, and the ET Wealth has given us their views as to what they think it should be in terms of the overall tax benefits and what the outlook is for the average investor as well. Hope you've got a clearer perspective on the national pension income in the scheme and what you should do. Moving on, we've got all of those viewer queries as well lined up. Let's get straight down to business. Ashutosh Kumar has connected with us. He's from Pune, and here's his question. He says, I have invested in mutual funds for the last 3 months, but given that the market is fluctuating quite a lot, is it a good time to invest more or should I wait? So let's find out what exactly one should do at a time like this. And one tends to see, Harshvardhan, that people get a little bit put off or get a little bit cautious. Will I burn my fingers? The markets are so volatile. One day I'm seeing this level, another day I'm seeing that. But I think when you look at the markets and investing in mutual funds, I believe you said it's imperative to look at a very long-term time horizon. That's key, right?
Absolutely. So one, if you're looking at a situation where this person has invested for 3 months and he starts to think about what to do with it, I think it's not the right product that he should be looking at. So Ashutosh, while I see your concern very clearly, you've been positive onto your query, at least wherein you've said that markets are fluctuating. So what you mean by fluctuating is, of course, in the last couple of days we've seen it correcting. So you're looking to possibly invest more or wait further for markets to go down. That is what your query is. So well, what I would suggest is that as an investor, don't look to try and time the market. I mean, we all might think that this is just the beginning of a bear phase, and you might just start waiting, and the markets will turn around from here. Your objectives have to be simple as an investor. I'm not talking as a trader. So if you're a trader, then you would want to look at market levels at regular intervals. But as an investor, if you're investing 6,000 rupees a month, I mean, or the amount that you've already put into the scheme right now, your objective should be what is the end purpose that you wish to achieve. Now, if your goals are 7 or 10 years away from now, there is no need for you to look at daily movements on a weekly or a monthly basis currently. If you have the money to invest, you have conviction in the Indian economy, you believe that all the pain that is there right now will get sooner or later smoothed out, then of course you will have to invest into equities and hope to get that kind of returns that you are looking at. So in the short term, markets are supposed to be volatile, and that's an inherent feature of the market. So do not get panicked. Do not panic with that kind of an movement. It is what it is supposed to do. You cannot just have a market going only one way either ways. It can't just keep going down. It just can't keep going up. So I think just hold on to your nerves. If you have the money, yes, of course, you can look to invest a little more, only if you have a long-term horizon and you believe in the India growth story.
Absolutely. Well, Ashutosh, hope you've taken note of that. Like Harshvardhan was saying, 3 months you're talking about, but as far as equity investments are concerned, it's good to look at it from at least a 5-year point of view. And remember also that during that time, the volatility of your investments also goes down. So don't try and time the market, as Harshvardhan was saying. But moving on, our next question comes in from Satish Patil from Kolhapur, who says, I have been investing 6,000 rupees a month for the last 4 years in Aditya Birla Frontline Equity Fund. I want to exit this fund and invest in Mirae Asset India Opportunities Fund. Is this a good idea? Please guide me. Well, Harshvardhan, I think the Frontline Equity is a strong fund in itself, and he's been holding on for the last 4 years, and a good amount, 6,000 rupees a month he's been putting in. But what is your recommendation?
So this is actually a typical case of chasing the current flavor of the market. So, Satish, when I look at the Birla Sun Life Frontline Equity Fund, it is a very good fund. It is a tried-tested fund. It is an older fund than the Mirae Asset India Opportunities Fund they are talking about. It has a larger AUM in that perspective. It's almost at about 20,000 crores, 19 to 20,000 crores is the AUM. This scheme has performed well across all market cycles. It has seen the bear phase, it has seen the bull phase, it knows how to ride all of that. While I appreciate the fact that you identified another good fund, which is the Mirae Asset India Opportunities Fund. So this is about a 5 to 6,000 crore fund, and it has been doing well as well. The question is, why would you want to leave Birla and go to Mirae when both are good funds? One may, for a particular period, may have given you a certain percentage points extra return, but that does not guarantee that will happen in the future as well. So what I suggest, continue being invested in the Birla Frontline Equity Fund. However, in case you wish to increase your investments from the current 6,000 a month to something more, then at that time you could possibly add the Mirae Asset India Opportunities. Not otherwise. There is no real compelling reason for you to do this switch at this juncture.
Okay, that's the outlook coming in on both the funds. You're in a fairly good fund right now, the Aditya Birla Frontline Equity. No need to really exit unless you're looking to invest more money via SIPs. Then Mirae Asset India Opportunities Fund, that would also be the way to go. On that note, let's take a quick break and stay with us. We've got lots more coming up on the other side, lots more topics to discuss, including whether or not you should increase your exposure to mid-cap funds, and we'll be answering a lot more queries. Stay tuned.
Welcome back. You're watching The Money Show, and we have with us Harshvardhan Roongta in the studio to answer all of your personal finance queries. So keep all those questions coming in. Harshvardhan, before we get to the next set of queries, another very important topic of discussion is mid-cap funds, because we've seen, how this kind of stellar returns that mid-cap funds have got, and a big question is whether one should continue to allocate, continue to invest in mid-cap funds, increase exposure, and also importantly, several of these mid-cap funds have restricted their inflows and have said only on one particular day or only a minimum amount can be put in. So what should existing investors do, and what should, if you're a new investor who wants to put in more money into mid-cap funds, what are the options available to you? And is that even recommended?
So in fact, if you look at market valuations, okay, so we look at the PE. If you look at the valuations, a mid-cap would be trading at about a 43 PE right now. You have a large cap at 24, a small cap at about 85. So now the question is, if you're looking at valuations which are so stretched, I mean mid cap at being 43 PE is really stretched, small cap at 84, 85 is stretched, Why are investors still looking at mid-cap funds? I mean, we have received n number of queries where the entire portfolio seems to be constituted only with mid-cap schemes. Now, if you look and deep dive into this entire scenario, you will notice that mid-caps, because they've run up so well in the last 1.5 years, that all investors want to capture that particular kind of return. So, if you had two schemes in your portfolio, one is a large cap and one is a mid-cap, and if you look at the performance after 1 year, wherein a large cap has given you, say, probably at 20% returns and a mid cap is giving you 30%, you will start to believe that the large cap is not performing well. Well, that's not true. You still have a double figure and a very, very good return by itself. So should you then migrate and put all your investments into mid cap? The answer is a clear no. Why? Because we are seeing the valuation stretched. As an investor, what you need to do is diversify your portfolio. And what is the meaning of diversification is not to have 5 mid-cap schemes in your portfolio. Is to have 5 schemes in your portfolio to represent different market capitalization. So you would have certain portion of your money invested in large cap, you will have certain portion in mid-cap, certain portion in multi-caps, and certain portion maybe in sectorial representation. However, at this juncture, one category of scheme that stands out and which could be a good pick into individual's portfolio would be a multi-cap fund. The idea of a multi-cap fund is it does not restrict itself, as per the objectives of the scheme, does not restrict itself to any single market capitalization. So look at a scenario, while we say do not take too much exposure in mid caps, but there could be certain situations wherein there are a few companies whose valuations are not stretched. At the same time, they have growth potentials. So if you avoid the mid cap segment completely, you avoid investing into future large caps. So mid cap today will become a large cap tomorrow. So how do you capture the situation where you want to cherry pick only the good mid cap companies? Now this is where a multi-cap fund comes into picture. A multi-cap fund has no restrictions of investing or any specific mandate of picking up an X company or a mid-cap or only large cap. The fund manager has a liberty to pick up and invest into any company which is across market capitalization. So while we see the multi-cap funds today being heavily tilted towards a large cap oriented portfolio, however, they still have the liberty to pick some companies which are very good in the mid-cap space and which have growth potentials. So to capture the good side of mid-cap and at the same time avoid being overtly exposed to that category, I think a multi-cap fund at this juncture would be most appropriate. So this is how you could possibly structure your portfolio and allocate more towards multi-cap funds.
Okay, so a lot of people feel like they've missed the bus. It doesn't mean that you can completely stay away from this sector or these funds, given that they are risky in nature. There is a lot of outperformance as well. So you can look at some of the options that have been flagged off by Harshvardhan: SBI Magnum Multicap, DSP BlackRock Opportunities Fund, as well as Tata Equity PE Fund and Aditya Birla Sun Life Advantage Fund. Well, let's move right on. We've got another query coming in to us from Chennai, and this one has been sent in from Jagannath. He says, which is the best mutual fund to invest for a healthy yearly income? And honestly, Harshvardhan, we restrict ourselves to take so many queries because we get so many of a similar nature. Which is the best mutual fund to really go for now? Unfortunately, Jagannath hasn't really specified his goals or his risk profile or how much he's even looking to invest. What would you like to tell him?
Yeah, so now if you're looking at a situation which is a query like this, which is open-ended, what we can make out of this query is that he wishes to generate a regular income, and that is the priority. Now, so there are very clearly, if you're looking to generate regular income, there would be only 2 kind of products that you can invest into, irrespective of the time horizon, because we need to know that bit of information. However, we can be safe in suggesting that you need to pick a scheme which either invests 0% into equities, or a scheme which is hybrid in nature and has a maximum exposure of 25%. So you cannot have an all equity fund or a balanced fund which has 65 to 70% in equities and hope to generate a regular income on a consistent basis, because of the equity exposure, the markets go down, the profitability gets affected, and obviously you will not be able to generate regular income. So keeping those sentiments in mind, these are the 2 kind of schemes that he can pick and invest into. While as I said, on the debt side, when you're taking an investment into a product which has 0 equity exposure, you would have funds like a short-term fund or an income fund which you can choose a dividend payout option. On the other hand, from the hybrid category, there are options available which into schemes which have an exposure of as little as 5% into equity and going up to 25% in equity. Now these use the name come under the nomenclature of monthly income plans. So because they are hybrid and they have some portion of equity in it. Now depending on what exactly the gentleman requires, you could pick a scheme and invest into them. You need to be aware of the risks that are involved. Another important point you need to know is that any mutual fund scheme will not be able to guarantee you any fixed regular income. So there is a dividend payout. However, the rate of dividend is not known to you at the time of making the investment. Now, why you need to know this? Because this is far, a departure from what fixed deposits do. When you invest in a fixed deposit or a bond or any of that, fixed interest instruments, you will know in advance what is the rate of interest you're going to get and when you're going to get it. While that is not the case in case of mutual funds. So just be clear about these differences. I've told you the category of funds that you can choose. Now within that category, depending on how much risk you can take and what is your outlook, you can pick a scheme with either no equity at all or an equity exposure of between 5 to 25%.
All right, Jagannath, hope you've taken note of what Harshvardhan had to say. Well, moving on, our next query comes in from Rohit from Mumbai. He says, I want to invest 10,000 every month in mutual funds and the goal is to buy a house in Mumbai in the suburbs. Please suggest which mutual fund to invest in and are there any other avenues that I can look at to make smart returns? Well, Harshvardhan, what would be your advice for Rohit? He hasn't really specified a timeline that he's looking at, but given that he wants to invest about 10,000 rupees every month for his goal.
So, well, exactly, we cannot get into specific schemes because we really don't know what is the time horizon he has, because if you're looking to invest and buy a house within the next 2 or 3 years, then you would need to go in for a debt scheme. If you have a time horizon which is more than say 5, 7 or 10 years, then equity is obviously an asset class which you need to invest into. So in the absence of that particular information as to what is the time horizon, it is difficult to recommend any specific scheme. As I said, we could do is give him a time time slab that in case you want to invest for a period of say 2 or 3 years, then it has to be in a debt scheme with no equity exposure, and if it goes beyond 3 to say 5 years, then a hybrid scheme with some portion of equity, and if it's more than 5 years hence that you need to buy a house, then equity 100% equity fund is something that you can consider. Another area which I'd like to make a comment on, because again it's a very vague and a broad term, he wants to make smart returns. Now what is smart? I mean, you'd have to start quantifying this. Why? Because unless you quantify what is smart in your opinion, you will get into a wrong product. Sometimes smart for people means just to beat inflation. Sometimes smart for people means that they want a return which is beyond 20% in nature. So, taming your expectation or rather quantifying them will help you be content with what you're getting and you can plan accordingly. For me, if you ask me if I'm able to get a continuous CAGR return over a longer period with about a 17% return on my portfolio, I think I'm doing very well, because that is a return, that's the kind of return which I will make, I will create wealth for myself. I'm beating inflation by a wide margin. So 17% for me is good. However, if I get something between 14 and 17 as well, I would think that I've done reasonably well, because getting that consistently over a longer period of time is difficult. In one stretch of time, if I'm talking about 14 or 15%, you might say the last year has been 20% plus, so why am I talking less? But getting 20 or 25% continuously for a period of 10 years is impossible. You need to see an average that you would get over a period of time, and if that figure stands anywhere between 14 and 17%, I think you're doing very good for yourself. So also just quantify the returns that you're expecting, so that a scheme can be, a portfolio can be designed accordingly for you.
Okay, so maybe then you want to resend us your query, Rohit, once you have given us a few more details on what you think smart is, as well as how much you're looking to invest, and we can have an expert answer that. But for now, Harshvardhan, it's been great having you with us over the last 30 minutes and answering all of those viewer queries and giving us more insight into NPS. Do keep the questions and queries coming. Tomorrow on Friday, that is, we'll have Dhirendra Kumar joining in. Send in all your questions and queries on mutual funds for Dhirendra.